Philadelphia Eagles did a great job of managing the salary cap in 2025, which is why they were able to use the money they had to build a Super Bowl winning team. And the NFL salary cap is a great way to explain deferred tax assets and deferred tax liabilities. So here's a great document from Sport Track, NFL team salary cap tracker. So what you have at the top here is each team, active players, average age, which is important because the younger the player is, the bigger the potential investment you may want to make in that player. The total cap, what's the cap on total salaries for the team, and then how much cap space do they have? And you can see reading across, how do you allocate the cap? 53-man roster because the NFL is allowed to carry 53 players. Some of those players are on the practice squad. So 53 is the total that you get. What's important to keep in mind is that these commitments, this money committed in the future, is a future liability for the team. So if you've got a great NFL quarterback who's got a big cap number, you'll hear the term cap number, that means there's a big commitment into future years to pay that player. And that future year commitment or liability is a great way to think about deferred tax liabilities and deferred tax assets. Basics. A deferred tax liability means that you have a future liability, something in the future that is a bigger tax bill that you're going to have to pay. A deferred tax asset is the opposite, meaning that you have a future deduction, a future reduction in your tax liability in a future year. The most common example is a difference in depreciation. This is the easiest one and frankly the most common one that you'll see, particularly if you're studying for the CPA exam. So why do we have a deferred tax issue at all? In this case, book or accounting income is different from income on the tax return. And in tax returns, depreciation can be different than the depreciation you use for book or your accounting purposes. So that's what I say here. Specific difference. Depreciation expense differs between book, your accounting records, and tax. So looking at this chart here, we have pre-tax accounting income, depreciation on the tax return. We subtract and we get taxable income. We multiply it by a tax rate and we get a tax payable of 6120. And that's how the rest of this chart works, moving across. Now, let's look at the differences. Let's assume for book purposes that you're using straight line depreciation for an asset and it's $30,000 a year for 4 years. But you're using an accelerated method for tax purposes, meaning that you're getting more of a deduction, depreciation expense in the early years, as you can see, and you're getting less in the later years. And a really important point is that when you add it all up, depreciation for book purposes and depreciation for tax purposes in total is the same. It's $120,000. No difference in total depreciation I put down here. So let's just take 2009. In this case, we have a temporary difference that the depreciation for tax purposes is $9,600 more than it is for book purposes. It's an even bigger number in 2010. Then it reverses, where we have more depreciation on the books here, more depreciation per book here. So what does this do to your tax return? Well, if you slide down, we have a difference. We multiply it by the tax rate, which means that the impact of book and tax depreciation being different is in green, $2,880. Same thing here. We've got a difference. We multiply it by, we've got a cumulative difference, I should point out. See, here's the cumulative difference, which is the sum of the first 2 years. 32,400, we multiply it by the 30% tax rate. We get 9720. We've already recognized 2,800 over here. And so the difference is 6,840. And so you move across. Now what happens is, here's the point. You're getting more depreciation on the tax return in 09 and 010. You're getting less depreciation on the tax return in 11 and 12. So the bottom line is that if you slide down, you've got a deferred tax liability in 09 and 2010. You've got a deferred tax asset later on in later years. So if you look at a T account, which I think is the easiest way to explain it, Here's the deferred tax liability. It's a credit for '09 and '10. You have deferred tax assets in later years. Again, deferred tax liability, you have more of a tax liability in future years. Deferred tax asset, you have less of a tax liability in later years. And the way to think about this is think about those future dollars that the NFL teams owe these players. That is a future liability. And that's a way of remembering how this works. The thing to remember here is that a deferred tax liability is a larger future tax payment due. A deferred tax asset reduces future tax payments.